Today we have Michael Tyrala speaking on the topic of accumulation by taxploitation, a world systems analysis of offshore tax dodging and the mounting resistance against it. Michael is a postdoctoral fellow at our institute. He completed his PhD in international political economy at City University of Hong Kong and has research interests which lie at the intersection between international relations, political economy, and historical sociology. He's held a number of policy-related positions, including posts at NATO, the European Economic and Social Committee, and the Trade Union Advisory Committee to the OECD, where he worked on a couple of official publications on reforming the international tax system. So he's really an expert on tax evasion and kind of the international politics of tax law. So we're very happy to have him talk to us today on what I think will be a very interesting topic. So Michael, it's all yours. The floor is all yours. I think you need to unmute.
Sorry. Can you hear me all right, everyone?
Yeah, you're fine. Go ahead.
Yeah, okay, so I can speak in this way, yeah? Or should I speak louder? All right, okay, so let's get to it. Let me begin my presentation. Okay, hello everyone. Welcome to the seminar. Thank you, Albert, for that introduction, and thank you all very much for tuning in. Today I will be talking about my dissertation research, which I have conducted over the course of 5 years between 2013 and 2018, and which upon finishing turned into a 200,000 word monstrosity that I'm currently trying to turn into several papers and 2 books alongside other related projects that I have going on. So there is a lot of ground to cover, and of course I will not be able to cover anywhere near all of it. As the title suggests, my research is centered on offshore tax dodging and on the relatively recent and still very much ongoing backlash against it. And by way of this presentation, I would like to shed a bit more light on both. The presentation is divided into 5 sections. First, in order for all of us to be more or less on the same page going forward, I establish and elaborate on some of the key terms, characteristics, and facts related to offshore tax dodging and what I refer to as the historic reform momentum. Second, I explain where my research fits in with existing literature and contemporary thinking and what it is I was specifically interested in. Third, I briefly introduce world systems analysis, which is the theoretical approach that I found to be the most useful for the kind of research I had in mind. After that, I get to the empirical part of the presentation, where I focus on several historical events, which I argue are absolutely key for an accurate understanding of where we currently are and where we are heading with regard to offshore tax dodging and the historic reform momentum. And finally, I bring the theoretical and the empirical together and summarize the main findings. All right, so on to the background, and let us begin with offshore tax dodging as such. Offshore tax dodging means intentionally not paying taxes, right? So either by hiding taxable income from the authorities, which is tax evasion and is by definition illegal, or by exploiting unintended loopholes, which is tax avoidance, and occupies an uncertain gray zone between illegality and legality. But even in the best of cases, tax avoidance is still widely regarded as immoral and undesirable, and the distinction is in any case unnecessary for our purposes here. So offshore tax dodging is the umbrella term for both tax evasion and tax avoidance using secretive offshore structures, which means that it pertains specifically to the kind of sophisticated grand scale tax dodging that is almost exclusively perpetrated by wealthy individuals and multinational enterprises, since they are the only ones that can afford to pay for the services offered by tax havens and the intermediaries, mostly from the accounting, law, banking, and finance sectors, without which none of this would be possible. To understand how offshore tax dodging works, it is important to clarify that while the term offshore generally connotes a geographical category, being somewhere offshore, In the context of tax dodging, it is actually a legal one. As such, offshore tax havens are essentially legal spaces that decouple the relocation of the economic transactions from the legal location and hence remove the tax liability of the transaction from the place where it actually occurred. So they are highly specialized jurisdictions that offer a variety of services to help wealthy individuals and MNEs dodge taxes, with most offshore tax dodging schemes requiring the interplay of several specializations from several jurisdictions. Typically, offshore tax havens offer their clientele lower zero tax rates, secrecy provisions, light and flexible incorporation with little to no substantial activity or presence required, or some combination thereof. The general idea behind most corporate offshore tax dodging schemes is basically to artificially shift profits to tax havens and any costs to regular jurisdictions where the products are actually sold and where the profits are actually generated. All of this is perfectly demonstrated by the double Irish with the Dutch sandwich scheme. You can see there on the right, which is most famously associated with Apple and Google, which I don't have the time to explain in detail, but I do urge you to look up in the IMF study I took this graphic from, because it is a fun read. But basically it shows an MNE incorporated in the United States and selling its products or services in the UK, and which, in order to avoid paying the full applicable tax rates in either of these jurisdictions, instead artificially shifts profits out of them and costs into them through the tax havens of Bermuda, Ireland, and the Netherlands, each of which intentionally offers a specific advantage without which the scheme would either be entirely ineffective or considerably less effective. Okay, so now that we know a little bit about how offshore tax dodging works, let's take a look at what available data has to say about its size. To start with, as of 2015, somewhere between 7.6 to 36 trillion of untaxed financial wealth has been parked offshore, and this stash grows by somewhere between 200 to 850 billion annually, which in relative terms disproportionately affects developing countries. Now, these numbers do not include non-financial assets like real estate, art, yachts, racehorses, diamonds, gold bricks, or various other holders of value, a considerable proportion of which also happens to be actually registered offshore. So the problem is actually much worse than that. This amount represents around 8 to 38% of total global financial wealth that has been historically amassed up to that point, and around 3 to 14% of all historical wealth, period, financial and non-financial. So you can see that the damage is really, really huge. It's difficult to really imagine such numbers. So to put them in perspective, consider, for example, that in 2019, the official development assistance by the wealthiest donor countries amounted to only 153 billion, and this was the most generous year on record ever. Consider also that if this stash was taxed in the jurisdictions to which it actually belongs, aside from the US, the external debt of most countries and regions could be wiped out in a matter of few years. From this perspective, one could even say that the world is not facing a crisis of debt as much as it is facing a crisis of tax dodging, or perhaps tax compliance, with tax dodging having become basically absolutely pervasive. For example, according to voluntary disclosures, most of the MNEs from the Fortune 500, the FTSE 100, and the ASX 200 reported that they operate tax haven subsidiaries, and numerous studies have shown that this strongly correlates with their lower effective tax rates. Furthermore, almost 40% of all foreign direct investment is estimated to be completely artificial, likely done for tax purposes, and the growth of this phantom FDI even outpaces the growth of genuine FDI. And I'll stop here, but the list goes on and on. As for the impact of all this, it goes far beyond the revenue side, with offshore tax dodging also exacerbating income and wealth inequality, perverting market competition, undermining macroprudential and microprudential supervision, with studies even showing that offshore structures played a significantly negative role in every single financial crisis in at least the last 40 years. And once again, the list goes on and on. But what all of this eventually amounts to, if left unchecked, is financial, macroeconomic, and indeed societal instability, all of which we have been seeing around the world with increasing frequency and intensity. Fortunately, there has finally been a response to this, and an unprecedented one at that. It took a few false starts, but in 2011, the G20 mandated the OECD to seriously address the scourge of offshore tax dodging. And within a few years, the OECD delivered 2 new global standards, the 2014 Common Reporting Standard and the 2015 Base Erosion and Profit Shifting Project, both of which are milestones in tax transparency and are historic in that they represent the most far-reaching reform of the international tax system since it was created in the late 1920s. Now, having said that, these 2 global standards are more of a patch-up exercise, and they come nowhere near the fundamental change that is so sorely needed to effectively tackle offshore tax dodging. So that's not exactly high praise, but still they do represent a good start, and the momentum is far from over. For example, as these 2 global standards are in the process of being implemented at this very moment, in some countries already implemented, in some countries still being implemented, the pressure is still very much on. And in 2017, the G20 mandated the OECD to continue its work on taxing the digital economy, which is the new frontier. And while this work is still ongoing, it has already led to a number of very promising proposals. Other than the work of the G20 and the OECD, very promising proposals have also been coming out of the EU and also from India, for example. So there is a lot to be excited about, and this historic reform momentum will likely persist for many years to come. Okay, so in the previous section, I think I demonstrated that taxation in general is clearly an area with huge systemic ramifications, and that offshore tax dodging in particular has become a phenomenon of monumental significance that nowadays plays an immensely influential role in virtually every facet of the global economy. And as such, it should be studied extensively, one would hope. However, aside from a handful of notable exceptions, international taxation and offshore tax dodging have been almost non-existent as areas of serious inquiry in either mainstream or radical international relations and political economy, and their systemic importance remained either unacknowledged, downplayed, or misunderstood. The few expert explanations for the emergence of the reform momentum were severely lacking and were limited to largely ahistorical narratives focusing on proximate causes, most of which were related to the global financial crisis. For example, one oft-repeated explanation was that the post-crisis recession and the bailouts simply resulted in greater need for tax revenue, which finally motivated political elites to act, and this explanation became especially popular once the global financial crisis spilled over into the European sovereign debt crisis. The other popular explanation, closely related to the first one, was that political elites just needed to appear tough to placate furious publics. And since they failed to get tough with the big banks that were the culprits behind the global financial crisis, they used tax havens as scapegoats, especially the small island ones. There is, of course, some truth to these narratives. The crisis clearly played a role, but there are so many other dimensions to look into as well that are generally not considered in the literature. For example, the capitalist system and its crisis of legitimacy it's going through in the past few years, the changes in dominant ideas about the offshore economy and related matters, the structure of the international tax system, the interests of different states, class interests, lessons from past regulatory attempts, since offshore tax dodging was certainly not a new phenomenon, and more falling broadly under the political economy categories of interest, institutions, and ideas. So with all this in mind, I set out to answer 2 simple but I think important research questions. How did the historic reform momentum against offshore tax dodging emerge, and why at this particular point in time? As part of my research, aside from Hong Kong, I also spent several months in London and Brussels and half a year in Paris, where I interned at the OECD and worked on tax issues. I did some archival and documentary research on a variety of historical as well as contemporary, primary and secondary sources. I conducted almost 100 field interviews with government officials, tax professionals, tax justice campaigners, and other relevant local and international stakeholders in all of these cities. But a large chunk of my work was also theoretical, which brings me to world systems analysis. World systems analysis was the theoretical skeleton of my project and provided me with a very useful conceptual toolbox that I think is remarkably well suited to research on offshore tax dodging. And since there hasn't been almost anything written on this issue by world systems analysts, it was also an opportunity for a theoretical contribution to the literature. Having said that, because we have limited time, and I think most of you tuned in to hear about offshore tax dodging rather than world systems analysis, I don't want to spend too much time on this. So as not to go into the nitty-gritty of all this, basically world systems analysis is a macro historical framework that highlights the need to study everything within both a historical and the holistic systemic context. So world systems analysts have to consider the system within which the events and phenomena they are studying are taking place, which is of course the capitalist system. They have to consider interstate relations and the constant struggle of states to better their lot, their position in what is a rigidly hierarchical system. They also have to consider dominant ideologies and how they change over time. They have to consider the various secular trends that keep the system moving and evolving along a certain path. And finally, like everything, a system has a beginning and an end. And world systems analysts postulate that the current system has already been in a deep state of crisis, at least since the 1970s. Here you can see a very simple graphical representation of the last slide, and please do keep in mind that this is grossly oversimplified, since world systems analysts have formulated numerous other concepts not mentioned here, as well as a sprawling and detailed meta-narrative of world development that dates back at least to the 16th century, and in some cases thousands of years into the past. But don't worry, in my dissertation, I only went back around 150 years, and in this particular presentation, we will only go back by around 100 years, and we will not be staying in such a distant past for very long at all. Okay, so if I said that world systems analysis represented the theoretical skeleton of my research, now we will get to the empirical meat that directly addresses my two research questions. We will begin with the systemic underpinnings of offshore tax dodging and the mounting resistance against it. And the first one of these underpinnings is the architecture of the international tax system. So the architecture of the international tax system as it stands today was created in the 1920s, as I said, by the Western colonial powers and their business elites. And unsurprisingly, it was designed to serve their interests at the expense of the emerging powers and developing countries. It is, of course, a complex structure, but for our purposes here, it can be defined by two key characteristics that have quite shockingly persisted to our present day. The first characteristic is its skewed allocation of taxing rights, which benefits capital exporting economies, in other words, the advanced developed countries, which are the countries of residence of most of the world's MNEs, at the expense of capital importing economies, in other words, emerging powers and developing countries, the countries of source, the international markets where the MNEs sell a huge chunk of their goods and services. This skewed allocation of taxing rights is enshrined in a system of bilateral tax treaties, giving rise to the so-called source residence conflict. And this brings me to the second characteristic, which is its reliance on two specific legal fictions. So the problem with taxing was that it was very difficult to treat an MNE group as a single unitary entity without a great deal of international cooperation. Imagine a multinational enterprise operating in 15 countries. How exactly do you divide the taxes between all of them? Without significant cooperation, which in the 1920s was nowhere to be found. So the drafters created the legal fiction of the separate entity principle, according to which, even though MNE groups are in reality, of course, single entities controlled centrally in every significant way, for tax purposes, each subsidiary of the MNE group was to be treated as if it was a separate entity. Like this, tax authorities would have their jobs made relatively straightforward, as they would only be dealing with the accounts of the local subsidiaries, fictionally separated from the rest of their parent MNEs. By itself, this would of course quite obviously lead to another genuinely difficult problem, because trade between subsidiaries within a single MNE group is perfectly normal and common, and has presently been estimated to represent over 60% of total world trade. But obviously, when these related entities are treated as separate for tax purposes, it opens up the possibility for an MNE group to artificially structure any trade and investment taking place between its subsidiaries by manipulating the transfer prices of these transactions in such a way as to shift its profits to tax havens and costs to regular jurisdictions. In other words, it made it extremely easy to engage in offshore tax dodging. In order to make this more difficult, the drafters created the legal fiction of the arm's length principle, according to which any transaction between subsidiaries within an M&E group has to be priced as if it was undertaken between unrelated entities operating at arm's length, which is to say by using market prices. And should a tax authority discover that arm's length principle was not adhered to, it would have the right to rectify the situation by adjusting such accounts and taxing them accordingly. However, in practice, this is much easier said than done, because finding comparable market transactions on the basis of which to determine what constitutes an arm's length price is a tremendously difficult and time-consuming exercise, requiring the use of various complicated transfer pricing calculations. And with the capitalist world economy constantly maturing into ever greater complexity, the exercise has only grown more difficult. So in other words, the way the architecture of the international tax system was built turned it into kind of an honor system with very little oversight that tax authorities could do. So here are the two key takeaways. The first is that emerging powers in developing countries are thus highly motivated to fundamentally reform the international tax system and have been for a very long time trying to. But their attempts continue to be shut down and vetoed by the developed countries, mostly the US and the UK, but also a few other European countries. And the second takeaway is that the architecture of the international tax system has unintentionally, from the very beginning, been facilitating offshore tax dodging. Of course, back in the day, offshore tax dodging was nowhere near the problem it is today, which brings us to the modern proliferation of tax havens and offshore tax dodging. Some of the oldest legislative tax haven acts trace back all the way to the 19th century, but the modern proliferation of tax havens and offshore tax dodging is tied to three more recent phenomena. The first of them was an obscure 1957 Bank of England ruling, which decreed that transactions undertaken by UK banks on behalf of a lender and borrower who themselves were not located in the UK were not to be officially viewed as having taken place in the UK for regulatory purposes, even though the transaction was only ever recorded as taking place in London. Such transactions thus became effectively unregulated, or in other words, offshore. The second phenomenon was decolonization in the 1960s, which left many new jurisdictions looking for niches in the global market, and many colonial powers actually encouraged them to become tax havens. And finally, the third one was globalization and the advances in transportation and communication technologies, which made offshore services much more easily and widely available. But the reason why this is important is that this proliferation of tax havens led to some profound ideological and systemic changes. Namely, it very much contributed to the rise of neoliberalism. The way this happened was that the establishment of an unregulated offshore financial market, the British Euro market, so-called, essentially torpedoed the whole Bretton Woods system of capital controls, since it enabled wealthy individuals and MNEs to circumvent the key regulatory provisions and restrictions on capital movements which that system was based on. So with the foundations of financial offshoreization laid down, increasing amounts of flight capital began pouring across the borders into this newly created unregulated space and out again, exacerbating what was by the late 1960s already becoming a complicated situation, what with the falling profitability and growing social unrest around the world. It was this flight capital that put stress on the system of fixed exchange rates in 1971, leading the Nixon administration to suspend the US dollar convertibility to gold and allowing exchange rates to float, rendering the Bretton Woods system all but inoperative, and by 1973, effectively abandoned. So it was this chain reaction that precipitated both the fall of what was until then the dominant centrist liberal ideological paradigm of Keynesianism and the consequent rise of neoliberalism, the ideological paradigm based on competition, liberalization, privatization, deregulation, and low tax rates. And with the ascendance of neoliberalism to ideological dominance in the late 1970s also begins the golden era of tax havens and offshore tax dodging. However, the very same things that made the mutualistic symbiosis between neoliberalism and the offshore world so successful also increasingly led to crises and future hardships for both neoliberalism and the offshore world. For example, while the adherents of neoliberalism wanted to undergo the several rounds of financial deregulation that happened in the 80s and the 90s regardless, it was the competition from tax havens that gave them the excuse, leading to a regulatory race to the bottom. They could basically say to policymakers, listen, we need to deregulate because the tax havens are there, they are operating, and all of the money is flowing there. So if you want to stay in the game, you need to deregulate. And it very much worked. Other than that, as already discussed earlier in the impact section, the tax havens also exacerbated crises by enabling capital flight, by contributing to the growing public debt, thanks to plunging tax revenues resulting from offshore tax dodging, and later by registering risky financial instruments and shielding them from regulatory oversight, which was especially the case in the recent global financial crisis. This crisis then led to today's loss of legitimacy of neoliberal capitalism, which in turn led to growing resistance against it, as well as the offshore world, which was closely intertwined with it. And this brings us to the rise of the global tax justice movement as a key resistance actor. So some prehistory of the global tax justice movement can be traced already to the late 1970s in the UK and the USA. And some important academic and NGO work with a distinct tax justice flavor began appearing in the 1990s, but its modern rise really begins with the activities of one John Christensen. He was born and raised in the tax haven of Jersey. In the mid-1980s, he worked for Deloitte, and in the 1990s as Jersey's chief economic advisor. And both of these experiences have left him increasingly disenchanted with the offshore practices he witnessed in both places. In the late 1990s, he began doing more research, spreading awareness, publishing papers, campaigning, and assembling a small team of like-minded experts. In 2003, with several of these experts and campaigners, he founded the Tax Justice Network, the first global NGO focusing specifically on tax justice. Tax Justice Network used a variety of tactics to spread awareness of the problem and its possible solutions. Initially, it was very much a guerrilla operation, and their tiny, largely self-funded operation conducted so-called berserking raids, which sounds very action-packed, but was basically just about going to as many academic and industry conferences and meetings on the topic as possible, and using the Q&A sessions to challenge the established common sense and bring new perspectives to the table. Nowadays, the Tax Justice Network has built quite a reputation for itself and is using more sophisticated methods, such as the Financial Secrecy Index, which has been updated every 2 or 3 years since 2009 and uses around 20 different indicators to assess and rank around 130 jurisdictions according to their secrecy and the scale of their offshore financial activities. It is now widely used by the media, by academics, by politicians, and is well worth having a look at. The other example is the TaxCast, which is a monthly podcast that since 2012 reports on the latest news from around the world related to issues of tax justice. And nowadays it also has several language versions, and it's likewise worth having a look at. But methods aside, shortly after the founding of the Tax Justice Network, the NGO released a list of solutions to tackle offshore tax dodging, the most important of which were these 4. The first 3 are nowadays referred to as the ABCs of tax transparency. So the first solution was automatic exchange of information, which they argued should replace the inefficient OECD system in which tax information was only exchanged between treaty partners and only once requested, which was a time-consuming process that usually led nowhere, as it gave criminals plenty of time to rearrange their affairs and cover their identity by the time the original information was received by the interested tax or law enforcement authority. The second solution was the setting up of beneficial ownership registers, basically company registers that would ideally be accessible to the public to ensure maximum accountability, and would list the ultimate beneficial owner of every offshore company so that it would be impossible for perpetrators to hide behind various fake nominee directors and such, which is a very common practice. The third solution was country-by-country reporting, which would ideally also be accessible to the public and would require MNEs to break their financial and tax reporting information down by country of operation, including in each tax haven, so that citizens and authorities can see what the MNEs are actually doing in their countries and how much in taxes they are paying. The fourth solution was the most revolutionary one and basically advocated for a complete overhaul of the international tax system, one that would do away with the aforementioned separate entity and arm's length principles, as well as with complex transfer pricing, and MNEs would instead be taxed in every jurisdiction where they operate based on a pre-agreed formula, such as a combination of tangible assets, payroll, number of employees, and sales, which would make a significant portion of offshore tax dodging schemes utterly useless. But of course, the problem is that it would require a high degree of international cooperation and coordination between states and their tax authorities. When this list of solutions initially came out, it was widely ridiculed as completely unrealistic and naive by most establishment figures among both the industry and the regulators. But the tax justice cause and the list of solutions gradually attracted the attention and favor of an ever-expanding set of actors that adopted it and began actively advocating it, eventually giving rise to the global tax justice movement and successfully politicizing and democratizing the problem, which had until then mostly been dealt with only by the technocratic establishment. A small group of academics have championed the cause from the very beginning, but their numbers are rising more than ever. Aside from a few exceptions, many NGOs were initially skeptical, but from around 2005, most global development, human rights, and anti-corruption NGOs have gotten fully on board, having been persuaded that offshore tax dodging severely undermines most of their other developmental causes. Journalists have been covering the occasional offshore tax dodging story for a very long time, but the problem of offshore tax dodging has gotten such traction since already the early 2000s that many major newspapers have now established a network of tax experts, investigative journalists, and even forensic accountants that dig more frequently and much deeper than ever before. From around 2010, even global trade unions began to realize that offshore tax dodging affects workers' rights, as they began to realize that they were frequently being deceived by M&Es during collective bargaining negotiations. For example, a major M&E group would artificially shift profits out of its French subsidiary to a tax haven, which would artificially make it unprofitable and thus eliminating its French tax bill. But this was also used to suppress wages and keep workers docile, because the subsidiary would basically say, look at the numbers, we're losing money, you're lucky to have a job at all. Of course, the M&E group as a whole was often making record profits. So global trade unions too began to join the tax justice cause with full support for the aforementioned list of solutions. And nowadays, several trade unions even conduct active investigations together with tax justice NGOs, such as in the offshore tax dodging scandals of McDonald's and Chevron. Then we have the various feminist, racial justice, and environmental movements, institutional investors, and even SMEs, all of which are increasingly joining the movement as well, because they too have began to realize, and studies increasingly confirm this, that offshore tax dodging negatively impacts them all, disproportionately so if they are from developing countries. As for the gender and racial dimension, there is, for example, because when states lack tax revenues and are unable to provide basic education or healthcare, it is usually women that make the sacrifices to educate or take care of the children. And because of institutional racism, it is often people of color that are more dependent on various state programs. So offshore tax dodging hurts these groups more than others. For institutional investors, the issue is financial and tax transparency, because without accurate information, there are considerably more risks involved in investing. For SMEs, the issue is unfair competition with large M&Es, which essentially enjoy lower tax rates. So the tax justice movement is truly becoming a grand coalition, but one of its greatest successes has to be the stream of leaks and hacks they have inspired. It is a stream that is very much becoming a flood, and it is very much keeping offshore tax dodging in the limelight and keeps the pressure on political elites and the regulators. And in almost all cases, the whistleblowers who risk their freedom and sometimes even their life have said that their motivation was the conviction that the practices they exposed are wrong and should be brought to light. So there is this moral change as well. Here we should also highlight the importance of technological progress, because, for example, leaks like the 2016 Panama Papers, which amounted to around 2.6 terabytes of data, would simply be impossible even 10 years earlier. Nowadays, all you need is a small hard drive. Before, you would need dozens of them. And before that, you would have to figure out a way how to photocopy or smuggle several warehouses worth of documents. So these are new methods that were unavailable before. But of course, the true measure of success of such a movement is what they were actually able to achieve. But in order to fully appreciate that, let's take a brief detour and have a look at some of the past attempts by politicians and regulators to rein in the offshore world. So early mentions of Western M&Es using foreign subsidiaries to avoid taxes date back to the late 1920s, and then again in the midst of the New Deal reforms in 1937, but none of this really amounted to much on the regulatory front. It was in 1961 that interest in tax havens rose again, so 4 years after the aforementioned obscure Bank of England ruling, and they were considered to be a problem of such magnitude that President Kennedy himself called for the elimination of the tax haven device anywhere in the world, even in the underdeveloped countries, and he even had a comprehensive bill ready to be passed. However, fierce opposition by the Republicans and the big business lobbyists led to a significant weakening of the final legislation, and Kennedy was assassinated shortly thereafter, not because of tax havens, as far as I know. The next major regulatory episode took place in the early 1980s, when increasing suspicions that double tax agreements were being abused for tax purposes prompted the Carter administration to commission the Gordon Report, which was the most comprehensive examination of tax havens and their clientele to date. Its findings confirmed the staggering growth of the offshore sector in just the past 10 years. The report clearly identified the problem of lacking effective information exchange and transparency and proposed a coordinated multilateral attack on tax havens. But history repeated itself again, and the proposal was defeated by opponents led by the Chase Manhattan Bank, which claimed that any action in this direction would make US businesses uncompetitive. Here we are already in the paradigm of neoliberalism, so competition came above all else. It took almost 20 more years for tax havens to resurface on the regulatory agenda, and for the very first time in history, it began as a serious multilateral effort. In a more or less parallel process, the OECD, the FATF, and the FSF, the FATF being the Financial Action Task Force and the FSF Financial Stability Forum, were tasked by the G7 to look into tax havens in their respective fields. In what was dubbed the attack of the alphabet, the OECD launched its Harmful Tax Competition initiative with the landmark 1998 report, which confirmed the fears that tax havens led to the erosion of national tax bases. The goal was to set up minimal standards with which OECD members and the identified 35 non-member tax havens would have to comply or face being publicly blacklisted with sanctions to follow. Embarrassingly, OECD's very own tax havens, Switzerland and Luxembourg, publicly denounced the report and refused to be bound by any of its provisions. Seeing this weakness, the Isle of Man signed up for the initiative, but with the condition that any reforms to be introduced must apply to all OECD members as well, including Switzerland and Luxembourg. While some tax havens seem to have folded under the pressure and began signing memorandums of understanding, others joined forces and fought back. They established international tax and investment organizations to represent their common interests and began lobbying bilaterally with individual OECD member states, as well as through their links to the Commonwealth. In what turned out to be an important development, as I said, the Isle of Man made commitments to the OECD, but yeah, again, just as long as Switzerland and Luxembourg do it, which was basically a non-starter. But the biggest nail in the coffin came with the coming to power of the Bush administration. A massive lobbying effort by US libertarian and neoliberal think tanks swayed a number of congressional Republican heavyweights, 86 of which wrote a letter to the new US Secretary of the Treasury, Paul O'Neill, and numerous other high-ranking officials in the new Bush administration on behalf of the tax havens. And if you are still paying attention, you know very well what happened next. Soon after, in 2001, O'Neill lambasted the OECD and single-handedly watered down the initiative beyond recognition. Since then, things on the regulatory front have begun to look up. For example, in 2005, the EU passed the Savings Directive, which mandated annual automatic exchange of information, although it was in a very limited scope, and it essentially failed because it was filled with so many loopholes that it was completely ineffective. But in spirit, it was certainly progress. In May 2008, there was a very important event with the eruption of the UBS tax evasion scandal, which set off an avalanche in the Swiss banking community, with the US Department of Justice subsequently launching criminal investigations into 15 other Swiss banks, aside from UBS, accusing them of conspiring to help their American clients evade taxes and getting guilty pleas for most of them, which began the biggest crackdown on Swiss banking in history. This very much gave the appetite to especially American regulators, and 9 years later, catalyzed also by the global financial crisis and fresh on the heels of the UBS tax evasion scandal of 2008, the new administration of Barack Obama passes the Foreign Account Tax Compliance Act. FATCA was enacted in March 2010 and is rightly considered to be a game changer. It basically asked all foreign financial institutions anywhere in the world to register with the IRS and report the relevant account information of all their US clients. While the registration is technically voluntary, all non-participating FFIs would face an automatic 30% withholding tax on certain payments of US source income. Non-participation thus essentially means being excluded from investing in the crucial US market. More than that, FATCA likewise required all participating FFIs to withhold the 30% on payments to non-participating FFIs, meaning that its regulatory reach extended to hundreds of thousands of intermediaries. Any legal jurisdictional conflicts this created were technically left up to the FFIs to resolve. So basically, the Americans sort of externalized their tax compliance with intermediaries having to bear the costs. But the most important thing about FATCA in this context is that it was a direct influence on the Common Reporting Standard, which was also colloquially known as GATCA, as in Global Account Tax Compliance Act. In terms of other tangible progress, I'm going to return to the Tax Justice Network's list of solutions. And here we can see that they have been remarkably successful for a small movement. For example, when it comes to automatic exchange of financial and tax information between FATCA and the Common Reporting Standard, this has become a standard. When it comes to beneficial ownership registers, this is still not a global standard, but in the EU it very much is, and this includes the UK and several UK tax havens. When it comes to country-by-country reporting, this is also now a global standard, except that it is not yet public or accessible to the public. It is only for tax authorities, although the EU has proposed public country-by-country reporting in 2016, and it appears to be just a matter of time. So pretty much the only thing that the tax justice movement hasn't achieved yet is unitary taxation, but even there are very interesting proposals, both in the EU and also with the new BEPS 2.0. Right, and basically, I think I'm out of time, so I'm just gonna sort of get to answering the questions. And basically, my research shows that the historic reform momentum against offshore tax dodging emerged at this particular point in time as a result of several historical factors and processes, including the gradual loss of legitimacy of the dominant neoliberal ideological paradigm, the relative weakening of the United States vis-a-vis several emerging market powers, the steady growth and successes of the global tax justice movement, the unique challenges arising out of the digital economy, and several secular trends such as politicization, democratization, bureaucratizations, transparency, and technological progress. A lot of this I haven't had any time at all to cover in this presentation. I mostly focus on the Global Tax Justice Network and the ideological dimension, but I think I will finish here and we can open up the floor to some questions. Of course, if you're even beyond the Q&A, if you have any questions or comments, please feel free to write. Thank you.
Great. So let me entertain questions. If you want to raise a question, you could use the hands up, but since it's a small group, actually you can just maybe unmute yourself and just speak out and just introduce who you are and then go ahead and ask your question. So if there's no immediate questions, maybe I can start with one, Michael.
Yeah.
So in the last slide, you talk about how the US is losing power relative to emerging market countries. But earlier, it seemed like the US reform to have international reporting of all of the bank accounts was—
You mean FATCA?
Yeah, the FATCA was actually a really important step. And since you had argued earlier that there was a lot of opposition among the business community, the big financial institutions against this type of reform, how did Obama manage that politically? Was it really because banks were kind of on the outs after the crisis? Or was there something else that changed in terms of the domestic political support for this key reform in the US?
Right. So when I was talking about the weakening of the United States, the United States is still definitely a dominant power, of course. But the thing is that before, in previous cases, it was actually successful in derailing even international efforts. But nowadays, basically, it is unable to. Right after the global financial crisis, the G20 was empowered to the level of the heads of state, which got China, India, and all of these emerging market powers into the game, including into OECD, where they now function on a completely equal footing with the other powers. And there are numerous cases where the USA tried to veto something, for example, during the BEPS project. For example, there was a Action 1 on the digital economy, which the US is not very interested in pursuing because most of the digital enterprises are American. So basically this is about, to them, this is about Europeans trying to tax American businesses. But they were unable to, they were able to only buy time, which is very different, for example, from the harmful tax competition initiative, where when the United States withdrew, the whole thing essentially folded on itself. So sorry, what was the second part of your question?
I was just saying.
Oh, FATCA, right?
FATCA and the politics of FATCA.
Right, the politics of FATCA. Yeah, one thing was the UBS tax evasion scandal, which was a huge deal in the United States, especially among the regulators. And also, yeah, there was it was basically a very, very lucky collusion of various circumstances. One was obviously the global financial crisis, which hit at an opportune time for this. The second was the election of Barack Obama, who in that first term also had both houses of the Congress. But even with that, FATCA passed, I think, by 3 or 4 votes. And even then it had to be smuggled in through some different legislation. I think it was some kind of a Jobs Act, as it usually is with tax bills in the United States. So the resistance to FATCA has been immense, but basically it was a stroke of luck that this happened. And this stroke of luck then emboldened also the OECD, which until then, even after the crisis for a few years, it just continued on its of signing tax information exchange agreements, these time-consuming on-request forms, and only once the USA moved first did they basically get inspired and were like, well, if the USA is doing it unilaterally in such a brazen way, then we can as well. And the US had no power to stop them, even though the US is an actor that has been quite strong against tax havens, but only unilaterally. The United States has been very interested in protecting its own tax base, but very uninterested in helping other countries protect their tax bases, even when it is itself is part of why the offshore tax dodging is happening.
Thank you. And we have a question in the group chat.
Yeah.
From Belinda Wong. She writes that for non-offshore jurisdictions, they may welcome the OECD tax initiatives, which may give them opportunities to collect more taxes. However, CRE, I'm not sure what that is, automatic exchange of financial information, et cetera, requires more interactions and negotiations among the jurisdictions who subscribe to those initiatives. Would that create more disputes among the jurisdictions?
Yeah, I would say definitely. And it also will probably open up a lot more cases in terms of privacy and something that I didn't talk about. I think when I mentioned the importance of technological progress and the proliferation of various leaks and hacks, with so much new information now being collected and being available to various tax authorities around the world, I think we will be able to see a lot more leaks and hacks even than up to this point. And we have been seeing basically huge leaks almost every year for the past 5 or 6 years. So I think this will be very good for transparency and tax justice, but of course it may very well infringe on some legitimate concerns of privacy, and also, well, some that I would say are less legitimate in cases where there is malfeasance going on.
Right. Okay, do we have any other questions from the audience? Anybody? All right, then let me ask another one last question from myself.
Sure.
So I mean, tax havens aside, when countries have different tax rates, then there's always kind of going to be an incentive for transfer pricing by multinationals to occur, right?
True.
And as you said, that's very hard to enforce. So it seems like if you're a low tax country, then you kind of have an incentive to be against reforming the tax haven, the policing of international capital flows or transfer pricing, because the money will kind of flow to the lower tax countries, right? If you're a high tax country, then you have a strong interest. Is that how the politics kind of breaks down?
Yeah, in many ways, yes. But nowadays, with the new proposals, for example, they're talking about the global minimal tax that will be somewhere around 10%. And there are various other ways how you can get around some of these issues. But yeah, I think that the point is that the political will nowadays being fed by not only the tax justice movement, but by the anger of the populations generally at elites using various ways how to get a leg up, the rising problem of inequality and all of these basically amount to very strong incentives even for some low tax jurisdictions to nowadays be less combative than they maybe otherwise would have been, and the pressure is really on more than any time than ever before.
Okay, thank you. Mimi Chen has a question, or Min Chen, is that right? Why don't you go ahead?
Yes. Yes. Well, thank you, Michael. It was very informative. So I'm from the MBA program, and I'm working in a company in mainland China right now. So we have the typical VIE structure, the very typical for companies in mainland China to get, say, funds from abroad. But then apparently that should be the end of 2018 when the merge of the Economic Substance Act, together with that CRS, I think that's the common reporting standard that the other classmate was mentioning in the chat. So now we are hesitating in whether this whole thing is going to work out. So, but then as far as we know, say the islands, say BVI, Cayman, those islands, those tax havens, they are kind of doing this out of pressure, not because they really want to do it, right? Because apparently this whole structure is bringing them benefit. So do you think that with say the Economic Substance Act and all that things going on, it's actually going to impact that, and then companies will stop doing it? Is it still doable, or say for companies like us, because we're not in the middle of building this VIE structure, should we continue doing it?
Well, I can't speak to a specific case, of course, but generally speaking, yes, the BVIs and various other small island tax havens, they are, of course, very unhappy about what is going on nowadays in the world with these regulatory pressures. And it is also true that there is a sort of a hierarchy, because most of the pressure is exactly on these small countries, but there are many other tax haven jurisdictions. For example, I mentioned Netherlands, and not many countries are picking on Netherlands, even though it's a major routing destination. So there is sort of an inequality of impacts. Having said that, for example, even CRS, first of all, there are numerous loopholes in the CRS, so there are various ways how you can get around that. Even though the OECD is very actively trying to fix that as they go forward. So they are very serious about making CRS work. But even though, even if BVI gets lost in this way for potential companies, the coverage of CRS and of CBCR is still relatively low, that there shouldn't be a problem in finding alternative jurisdictions. The question then, of course, is why is it a problem to have tax transparency? for a company. I mean, unless there is something, well, of course, there are some legitimate concerns with privacy, but unless there is something that at least looks bad, it shouldn't be an issue. So, I mean, if it's being used for legitimate reasons, there is no problem with using so-called tax haven jurisdictions. They do provide legitimate services. The problem is usually when they cover up something, right? The problem is secrecy. The problem is excessive anonymity, et cetera, et cetera. But I think many businesses use them also for legitimate reasons, and it's of course possible, and the CRS shouldn't be standing in the way of that.
Great. So we're getting more questions in. David Cook has his hand up. David?
Hi, Michael. Very nice talk. I'm from the econ department. Increasingly, the ultimate source of capital income is coming from intellectual property, which is quite interesting in that it's almost completely mobile, but is in fact also kind of in some sense completely constructed as a legal object. So I'm just wondering what does world systems theory point to as the kind of trends in the taxation of IP?
Right, yeah, you're absolutely right. IP is the next frontier, as I put it. The digital economy in general is nowadays mostly aimed at taxing digital enterprises, which usually use IP, which is the most mobile form of value that they can easily transfer, and that's basically what the new the BEPS 2.0 system is supposed to capture. Aside from that, aside from this multilateral effort, there are of course various unilateral measures. For example, India's equalization levy has tried to clamp down on digital enterprises. The UK's diverted profits tax. So there are various other methods. In terms of world systems analysis, and specifically to this, I haven't thought about it in detail. I think I would put it somewhere with regard to secular trends and technological progress, because again, we have this dimension that technology first enabled tax havens and enabled especially these new digital enterprises to basically pay zero taxes or very, very low taxes. But it is exactly this that also sows the seeds of what I think will eventually be the destruction of these methods, because nowadays there is a lot of focus on that, and actually this is the prime focus now, and that's something that America has really not been able to stop, at least so far. I mean, who knows what they have up their sleeves, but for now the work is very much ongoing, and the OECD is also increasingly, especially vis-a-vis digital enterprises, talking about so-called formulaic approaches. So even though the OECD is doggedly defending the separate entity principle and the arm's length principle, slowly already during the BEPS project, and especially now during BEPS 2.0, they are slowly letting them go, and unitary taxation, at least in some forms or for certain sectors, appears to be in the cards for the future.
So we have two more questions. We're at 5 p.m., but let's take these two questions before concluding. There's a question from Deanie. Deanie, would you like to ask your question? Are you there? Okay, then.
Yeah, I can ask the question.
Yeah, go ahead.
So interesting talk, Michael. And you spend a lot of time focusing on the role of NGOs and governments in shaping the new regulatory system for M&Es. But M&Es themselves, how they have shaped the negotiations, how they have participated and tended to lobby the new regulation.
Yeah, well, in the past, their influence has been quite strong and obviously negative. They were protecting most of the time and very successfully protecting their interests. But nowadays, the momentum has built to such a degree that even they nowadays see that they need to give something back, that they need to let some regulations take place. Otherwise, sooner or later, something worse is going to happen. And the most important thing for multinational enterprises is what they hate the most, what they want to prevent the most, is for the international tax system to become completely disjointed, right? So basically they know that if these OECD reforms don't succeed, at least partially, then various different jurisdictions, like we've seen in the European Union, India, and various others, they are going to start doing their own thing. And that increases their compliance costs, because now they will not be dealing with a single international tax system with a few outliers, but they will be dealing with maybe 50 different interacting systems. This may also create new opportunities for offshore tax dodging, of course, but at least in the short term, it will increase their costs. So they are very much trying to prevent that at this point. And of course, they are protecting their interests as always, but I would say that they are more docile than they have been forced to be more docile than in the past years.
Can I ask another question?
Yeah, go ahead, Dini, quickly.
Thank you. So with respect to the shareholding of these companies, have you seen a different approach to the tax system between listed companies and private companies and state-owned companies and private companies?
In my experience, no. It's the same rules that would apply to all, because again, both companies and regulators have very little interest to ring fence in any way either sectors or different types of companies. It's cheaper, better, and more efficient for everyone to have the same system. Although, for example, the digital economy has provided lots of challenges in this regard, but even that, the rules are being changed in such a way that they would apply to the whole economy equally without any kind of specific ring fencing. Okay,
Michael, the final question comes from the group chat as well, related to digital economy. What is the impact of, this is from Abel Matsogi, I hope I'm pronouncing that right. What is the impact of cryptocurrency on tax evasion or dodging?
I can't say I have been following up on this. I know it is increasingly a topic in terms of, because obviously cryptocurrency in generally is potentially a goldmine for offshore tax dodging. But I haven't really looked at this in any detail. And I think regulators generally are playing catch up as much as everyone else with regard to cryptocurrency. I think the moves that I've seen so far are very blunt. Either I think China at some point banned cryptocurrencies, and some other countries have moved in this direction, basically for fear of how it might be misused. But I think as of yet, this is still a bridge too far. This is being pushed forward as an issue. Right. Although I'm sure some experts are working on it, but I'm not familiar with that work.
All right, thank you very much. And with that, I'd like to close the event and thank Michael for a very interesting talk, and to all of the participants for a very lively discussion. So thank you very much. Please keep your eyes out for announcements for the Institute's next academic seminar.
Thank you.
Bye.